Okay, now let's finish this up. We have gone through the entire accounting cycle. So we have we've recorded our transactions all through the year. We've done our adjustments. So that we've updated all the assets and liabilities and recorded all the expenses and revenues that took place. And then we generated our financial statements. So now it's time to close out our accounting cycle. So whether it's a year or a quarter, so think of it like closing out the fiscal year. And we really have two things we need to accomplish here. One is that we need to update the account. So remember in the last one, when we were looking at the worksheet, I said that we said on the statement of owner's equity that we gave the net income to the owner, but we haven't done a journal entry to do that. So the balance in the capital account that's showing on the trial balance hasn't been updated yet. So we need to take care of that. And we also need to close out the year for to get ready for the new year. So everything, we have two different types of accounts here. We have temporary accounts, which are also called nominal accounts. And these are things that are related to or associated with a specific time period. Specific time period, like this year. And so basically, remember how the income statement and the statement of owner's equity, at the top of those, they both say for the year ended, or for the quarter ended, or for the month ended, whereas the balance sheet just had a date. So anything on those statements is actually associated with a specific time period. So the revenue account, any of the expenses, the withdrawals, and there's one other type of account that we haven't talked about yet, but we will do in this one, and that is called income summary. So any of these guys, revenue, expenses, withdrawals, and income summary, are temporary accounts, and that means at the end of the year or the quarter, I need them to have a zero balance so that I can start out. So on the income statement, I reported a net income, and that's for a period of time. That's all the revenues and expenses that took place over this year. Well, I'm getting ready to start a new year, so I need to close those out so they're not mixed in with the next year, so I can measure the performance of last year with this year separately. So I need all those to be able to close out. And so I need these guys to have zero balances so I can start with the next year. The other accounts are called permanent accounts, and these are basically the things on your balance sheet. These are still going to be here even though I'm starting a new year. So, for example, because the net income is associated with a year, I need the revenues and expenses to start out with zero. But my assets, my liabilities, and my capital account are all still going to be here. Just because I'm starting a new fiscal year, my cash is still there, my debt's still there, I still have to pay that, my building is still there. And so all those are still there. They're not specific to a time period. So those guys, let's make those green. Assets, liabilities, and capital are all permanent accounts. So they will still have a balance when I'm done this process. So the closing process serves two things. Number one, we zero out these temporary accounts. So I want to have a zero balance in the temporary accounts. And the second point here is to update the capital balance, because right now what's in the ledger account doesn't match what I said on the statement of owner's equity. So I need to take care of those. So this is the process that we use to close it. Step one is I close the revenues to this temporary account called income summary. Revenues have a credit balance, so I want it to be a zero balance, so I need to debit the revenue, each revenue account for its full balance. And so I debit revenue and I credit income summary. The expenses all have debit balances, so I need to credit each of those, and then I send the debit to income summary. So now, once I do step one and step two, revenue will have a zero balance, all the expenses have a zero balance, and the amount sitting right here in income summary is my revenue minus expenses, or my net income. And so on the statement of owner's equity, I said I gave that net income to the owner. So that's what I need to do. So I credit net income. I credit the capital account. I debit the income summary account for the amount of the net income. So if I'm crediting capital, I'm adding to it. So now I'm giving the owner, and then income summary have a zero balance, and the capital account has been updated with that net income. And the fourth step is to close the withdrawals, which is the other thing I said I did on the statement of owner's equity. So withdrawal has a debit account, so I need to credit it, and I debit capital. A debit to capital will bring the balance down, which makes sense. And so now this will have a zero balance, and the capital account, I gave them the net income, I took off the withdrawals, so this will now match my statement of owner's equity. So what I'm really doing in this process is replicating what I said on the statement of owner's equity. Owner's equity. The only variation to this is if I had a net loss, then I would end up with a, instead of a debit balance in income summary, I would have a credit balance in income summary. So I would be debiting capital instead of crediting capital. If it was a net loss, I need to bring capital down. So the closing entry, there are 4 journal entries, and I think they're easier than the adjusting entries because it's the same for every single time. So the first thing I do is I close the revenue account, if I have more than one, or if I just have one. Close revenue to income summary. So again, revenue has a credit balance, and I want it to have a zero balance. So I'm going to debit it. So I debit service revenue, and I credit income summary for whatever the balance in that revenue account is. So I'll put revenue balance, revenue balance. Again, these numbers are just coming off of your trial balance or your ledger accounts. So if I did that, here's my T account for income summary, and I credited that for the amount of the revenue balance. Step 2 is to close my expenses to the income summary account. So my expenses all have debit balances, so I need to credit those. So the debit is going to be to income summary. I'm going to write that first because I always write my debit first, but I'm going to leave the amount blank. And so then for each of my accounts, I would have rent expense, and I would credit that for whatever the balance in that account is. And I would have supplies expense, and I would credit that for whatever the balance is in the trial balance or in the in the ledger account, wherever it is. Depreciation expense, and I would credit that for whatever the balance in that account is. And then I total up all those credits, and that's the amount of my debit here to income summary. So then I debited it for the total of the expenses. Now, it should have a balance unless my revenues exactly equal my expenses, which would be pretty unusual. So I would have a balance here, which would be the amount of my net income. So the third step, and this is the one where people sometimes go wrong. The third step, I want to close income summary to the capital account, which means I want to give that net income to the capital account. So if income summary has a debit balance, it should have a credit balance, right? Hopefully my revenue is higher than my expenses, right? If I had a net loss, it would be over here. So hopefully I have a net income, and my revenue balance is bigger than my revenue is bigger than my expenses. So my credit is bigger than my debit, and my balance is sitting over on the credit side. So that means I need to debit that to make that go away. Income summary, and I'm crediting the capital account, which will add to the capital. And so I'm going to write income summary balance. If people make a mistake in their closing entries, income summary balance, it's because what they do, they're so used to pulling all of these balances from the trial balance that then they think they're closing capital to income summary, and they pull the balance off the capital account. But that's not, capital is going to stay there. I don't want that to, I'm not giving that to income summary. I'm taking whatever's in income summary and giving that to the capital account. So everything's coming from the trial balance except for this one, and you kind of have to keep track as you go. That's a little hard to read there, of what this is. So, I mean, you can just subtract it here and see what you did, or you can keep a little T account to keep a running total. But what I'm doing here is giving that net income to the capital account. And then the fourth, oops, where'd you go? The fourth step is to close the withdrawals to the capital account. Withdrawals have a debit balance, and so actually then here I would have sent that to capital, and so now this would have a zero balance. The withdrawals have a debit balance, so I need to credit those. So I'm going to debit the capital account and credit the withdrawal account for the withdrawal balance. Whatever's in the withdrawal account, that's the amount of this entry. And now everything will have a zero, all the temporary accounts will have a zero balance. Capital would have been credited for the amount of the net income and debited for the amount of the withdrawals. And so now the balance in the capital account will match my statement of owner's equity, and all the temporary accounts will have zero balances. So that's what that one looks like. Here's just an example in here that's probably a little bit easier to read. But if we keep track of what's going on in our income summary account, here I credited income summary for the revenue, 64.3. Here I debited income summary for the expenses, 23.3. So my balance in income summary right now is 41,000. That's the amount down here that I give to the capital account, and then the withdrawals. If this was a net loss, this one would be flipped, and I would debit capital and credit income summary. That's the only variation. This first one will always look the same, the second one will always look the same, the fourth one will always look the same. And this is what it will look like if it's a net income. If it's a net loss, you're just going to flip your debits and your credits. And again, think about what you're doing to the capital account. If it's a net loss, capital's coming down, so that needs to be a debit to capital account. And that goes all the way back to chapter 1, and remembering what your increase and your decrease is in different types of accounts. So here's one of the demo problems, and in this one they say we have the following balances, and you notice they don't even give us the capital balance because we don't need that for this one, right? And so we are going to, revenue has a credit balance, so we want to debit that. So I'm going to debit service revenue, and I'm going to credit income summary for the balance that's in the revenue account. That's 21.8. And now the revenue account will have a zero balance. The next thing I'm going to do is close the expenses. So I know that they have a debit balance, so I need to credit those. So my debit is going to be to income summary, and I'm going to credit each expense account. So I've got salary expense has a debit balance of 7,200, so I'm going to credit that 7,200. Rent expense has a debit balance, so I'm going to credit that 4,400. And advertising expense, I am going to credit that 2,600. So if I add those three together, the total debit to income summary will be 14,200. The third step is to close income summary to capital. So again, here's income summary. I credited it 21.8 and I debited it 14.2. So the balance, the revenues are higher, the credits are higher than the debits. So I have a credit balance of 7,600. That's how much I'm going to give to the capital account. So I'm going to debit income summary for the 7,600 and credit capital. And that will increase the balance in the capital account. Sorry, it's Thomas Capital or something. Oops, come back. Thomas Capital for the 7,600. So that's where I get that number. And then the last step is the withdrawals. And so I'm going to debit Thomas Capital and credit Thomas withdrawals for the balance in the withdrawal account, which is $6,000. 6,000. And so these four entries look the same every single time. The only difference would be if it was a net loss, I'd flip my debits and my credits over here. So let's just look at one more here where we're doing T accounts. So it has the following balances appear on the books of Brian Kaufman Enterprises, and so they want us to open a T account for each one and then post the closing entries to the accounts, denoting it as closed, and then compute the ending balance in the capital account. So we'll have, let's see, we've got 1, 2, 3, 4, 5, 6, 7. So let's see if I can fit all these on here. So we'll have Kaufman Capital, which has a balance of $30,000, and we know Capital has a credit balance, so that's over here. And then we'll have Kaufman withdrawals has a debit balance of $5,400, and then we'll have service revenue has a credit balance of $20,200, and then we've got our expenses. So I've got salary expense, and expenses all have debit balances, so that's $6,800, and then we have rent expense, which is $3,000, and that's on the debit side. And then we've got our advertising expense. I think these are the same ones we did in the last one. $3,200. And then we will also, doesn't have anything in it yet, but we will need an income summary account to do the closing entries. So I'm going to switch colors here. Let's go with blue. Oops. There it is. Let's go with blue. Alright, so the first thing I do in my closing entries is close the revenue to income summary, right? So I'm going to debit the revenue account, and I'm going to credit income summary. What are we doing down there? $2,200. Then the next step is to, oh here, I'll just do a different color for each step. How's that? Then the next step is to close each of the expenses to income summary. So I would do, I would debit salary expense, I would debit rent expense, I would debit advertising expense, and then those three together equal $13,000. And so now my balance in income summary is $7,200 on the credit side. So now I'm going to give that $7,200. So now all of these guys, the revenue and all the expenses have zero balances. Income summary is sitting with a balance of $7,200. So now I want to give that to the owner. So we'll make that green. So I would be crediting capital $7,200 and debiting income summary $7,200. So now income summary has a zero balance, and the last step, I'm running out of colors, purple, is to close the withdrawal account to the capital. So I would be debiting the capital account and crediting the withdrawal account. And so now all of these guys have zero balances, right? Zero, that would be on the credit side, and zero, and this is a zero, and now this is a zero. And now it asks for my new balance in the capital account, which will be the credit plus the credit minus the debit. So I end up with a balance of 31,800 is my ending balance in the capital account. So that's a very colorful little thing there, isn't it? But so this is the same thing we did here in the, well, different amounts, but these are the same things we did here. It's just here's how they look on the T accounts. So you can see that each of the temporary accounts has a zero balance, and the capital account has been updated. So the last thing we do here is a post-closing trial balance. So this is our third trial balance. This one's really easy because all of the temporary accounts, the revenues, the expenses, and the withdrawals, and income summary have zero balances. So they're not on here. And so only the permanent accounts show up on the post-closing trial balance. So that is our assets, our liabilities, and our capital account. So that is all that shows up. There's a little practice problem in there where you can just kind of see which ones show up and which ones don't. But you should have no revenue, no expenses, no withdrawals, and no income summary, because those should all have zero balances. But it is a good way to kind of check yourself and make sure that that those are all cleared out. The last section of the chapter here just kind of talks about the accounting cycle, and so they go through the steps. So you start with beginning balances. If you've carried some over, like for the permanent accounts, you analyze transactions as they occur, you post them, then you do the unadjusted trial balance, then you do the worksheet, and then you adjust the adjusting entries. I actually often switch those, but after you've done the adjusting entries, then you do an adjusted trial balance, and once you've done that, you prepare the financial statements, then you do the closing entries, and then you do the post-closing trial balance, and you're done, and you're ready to start the new year. So this is just a screenshot of a page in your book, but you can kind of see how the whole thing flows together. And so this is kind of what we did in chapter 2, and this is what we did in chapter 3, and this is what we did now in chapter 4. So you can kind of see how they all fit together. And then the very last thing here is again one of our financial ratios. Now, since this is the first time we split the assets and liabilities into current and long-term, this is the first time we can do this one. So the current ratio is just the total current assets divided by the total current liabilities. And we need the classified balance sheet in order to get this, because before we did the unclassified and we couldn't tell the current from the long-term. They're all mixed together. What this really describes to us is our ability to pay our current debt or our current liabilities with our current assets. Do I have enough cash, or do I have enough cash coming in soon in order to pay what's coming due soon? So with our current assets. Generally, if you get a current ratio of 1.5 or higher, that's good. If it's 1 or less, that is low, and that would be considered risky. That means right now you owe about as much as you have, and so you could get to the point where you are having a little trouble making your current payments. The last problem here is just so again, we just want the current assets when we're going to lower everything long term. So we want total current assets Assets divided by total current liabilities. So notes payable long term, I don't want that. Prepaid rent would be a current asset, so I'll put that here. Salaries payable would be a current liability, so I'll put that here. Service revenue is not an asset or a liability. Office supplies would be a current asset, so I'll put that there. Accumulated depreciation is a long-term asset. Advertising expense is not an asset or a liability, so I don't want that one. Accounts payable is a current liability. I'll put that one over here. Accounts receivable is a current asset, so I'll put that one here. Cash is a current asset. I'll put that here. Depreciation expense isn't an asset or a liability. Equipment is a long-term asset. Capital's neither one. And rent expense is neither one. So I have these total current assets divided by these two current liabilities. So I get 12,300 in current assets divided by 4,900 in current liabilities. So I get a current ratio of 2.51, which means they have more than twice as many current assets as liabilities, so they should be more than able to pay off their current liabilities. And that's chapter 4, and now it's time to get ready for your exam.